Hey there, welcome to today's video. Have you ever heard of a corporate action event called a stock split? Maybe you wondered why companies do it and how it affects their capital. Well, in this video, I'm going to explain what a stock split is using an example and also tell you why companies decide to do it. And hey, if you like what you hear, don't forget to subscribe and hit that like button so we can help others understand financial concepts too. Okay, so let's break down what a stock split event is in simpler terms. When a company goes public, they give out shares of stock to people who invest in their company. A stock split is when the company's bosses decide to make more shares available by multiplying the amount they have. They decide how many new shares they want to make, and there are a few different ways they can do it. The most common are 2-for-1, 3-for-1, and 3-for-2 splits. To understand the concept better, let's look at an example. So, let's assume there is a company named ABC Limited. Company has decided to split its stock and has settled on the most common split ratio, 2-for-1. In this example, shareholders who have already purchased and been issued shares of company ABC Limited would be given another share for every stock they already own. In such a scenario, let's assume that company has 30 million outstanding shares. After the 2-for-1 stock split, they'll have 60 million outstanding shares. However, this also means that the value of each share decreases by 50%. Stock split, as our example shows, increases total number of shares outstanding, but make 2 shares the same value as 1 share would have been before the split. Company's market capitalization isn't affected by this because the total market value of all outstanding shares hasn't changed. Now let's understand the reasons for stock splits. Why would a company want to double or triple its outstanding stock shares if its market capitalization won't be affected? There are a number of reasons for stock splits. However, there are 2 that are most common. The first has to do with perceived company liquidity. With each share's price dropping a certain percentage, depending on the ratio that the company decides to use, investors tend to see the company's stock as more affordable, and therefore may be more likely to buy shares. The lower the share price, the less risky the stock seems. A stock split makes the stock more affordable for more investors and thus can be used to draw in new investors who may have been reluctant or simply unable to purchase the stock at its higher, pre-split price. The move is a useful strategy when a company's stock price rises to a level that prices many investors out, or when the price has risen significantly higher than its competitor's stock. The second reason for stock splits is growth. When a company is growing fast, they might split their stock to make it look more attractive to investors. This is especially true for companies that are growing quickly. By splitting their stock, they can show investors that the company is doing well and has potential for even more growth. This can encourage more people to invest in the company, which can help it keep growing. I hope this information helps you understand stock split events better. This brings us to the end of the video. Give a thumbs up if you liked the video and do subscribe to get a notification for upcoming videos. Goodbye and have a nice day.